This is Randy Finney with the right side of the chart, and this is a mid-session update for Thursday, November 10th, 2022, video number 2. It is 12:14 p.m. as I'm starting the video. This one's going to be more of a macro, on the micro. As I mentioned earlier, for the reasons that I stated, including downtrend lines, Fibonacci retracement levels, and how much we're up. For me, it's what I call a hard short. A hard short on the indexes. Normally I'll go long something, short something, but a hard short means pretty aggressive, and I'll peel some of that off and decide whether I'm going to get it, hoping for and expecting at least a 1 to 2% pullback, and so on a big chunk of NQs, a lot of contracts that's going to pay off, or again should pay off. We'll see, and then I'll decide whether or not to let the rest run. I'll post some charts and updates on that later. Let me show you what I want to talk about, the big picture here, and that is where the market's at right now, where it's likely headed, and then the whole feedback loop between inflation, the Federal Reserve, what they're doing with rates, and what the stock market does, based on what the Fed does, or more importantly, what the stock market thinks the Fed's going to do. That's all what today is. That's all what the rally we had up into the FOMC meeting last week. Expectations of Powell would back off, the Fed would throw the market a bone. They didn't. The market went down. Now today, because of the a little bit of abatement, a little bit softer, still, believe me, still high inflation number, the market then assumes that the Fed is now going to hike less or cut or whatever they think, and that's going to be, and I've said this before, that's going to be the MO going forward for what I believe to be the foreseeable future. Hard to say how long that is, but I'm talking a time span measured in many months, if not years, most likely. And let me just dive into what I'm going to show you here. So, it starts with where, big picture, where I think the market's going, and this is my QQQ chart, QQQ being really the leading index. There's my primary bull market uptrend line. It's a nice clean uptrend line with a lot of distinct reactions. Comes off the NASDAQ was the leading index back at the end of the bear market bottom, technically before everything else in November, but then made a slightly lower low. But you still come in and capture both those lows. You had a flash crash right here in 2015, perfect tag of the trend line. More pullbacks to the trend line here and here, 2018, 2020 when COVID hit, and now we're below it. So this is one, but not the only, but one of many reasons. I believe we're in a bear market that is far from over. And not only that, you have my big 20-month exponential moving average does a phenomenal job of defining trends. So we're well below it. So again, nothing's changed in my longer-term outlook to intermediate. It's more of a matter, are we going to rally back and test those once more? We've already tested that 20-month a couple times after taking it out. And again, there's no guarantee that if we get up there, that's the end, but just a mountain of evidence here. That primary bear market downtrend line and what I call my beautiful 20-month exponential moving average, one of the best and most simple indicators to define the major trends. And so if we got there, and you can see I have a trend line there, a yellow, there's that primary trend line as well, which we took out. Remember, that is the bear market uptrend line from the 2008 lows, because in my book, COVID and the big fourth quarter, 24% from high to low drop. So technically in QQQ, a 24% drop's a bear market. So is a 31% or whatever it was there. But they were just corrections that took us back. So that's it. So it's a matter of, we're going to rally up there. And of course, if I'm wrong, we start to take those levels out and we get a solid monthly. Remember, this is a monthly chart. Monthly close above there starts to chip away at that longer-term bearish case, because you'll have regained the trend line, you'll have regained the 20-month, etc. So let's not get too far ahead of ourselves, because we have quite a bit of ways to go if we're even going to backtest those levels again or not. And then we'll talk about it when we get there. So I just wanted to kind of, again, instill my or impress my where are we now thing, where are we going. And if that's the case, no bear market goes straight down, no bull market goes straight up. They all zig and zag. Bull markets are like escalators, stair stepping up, and bear markets are like an escalator on the way down, stair stepping down. All right, so we've established that, or at least that's the theory I'm working off of, and at some point I'll have to, if the charts tell me, I'll adjust my theory. So now let's talk about feedback loops. All right, and so there's two types. A positive feedback loop enhances or amplifies changes, and that tends to move a system away from its equilibrium state and make it more unstable, whereas negative feedbacks tend to dampen or buffer changes, and that tends to hold a system to some equilibrium state, keeping it more stable. In other words, from that, you're talking about feedback loops. The one I'm going to talk about is interest rates, inflation in the stock market. So if we're going off that, just again, assume that you buy into my theory that there's a bear market with more to come, then that's the primary system, if you will, right there. And so these rallies, and I've talked about this, you're going to get abatements in inflation. You may have true pivots from the Fed, to a pivot, can be, the term is relative. It doesn't have to mean from hawkish to dovish. It can mean from very hawkish like they are now to a little less hawkish, right? That's the pivot the market. That's all they've been wanting lately. And even though Powell hasn't opened his mouth today, that's what the market assumes he's going to do. And so that's why it's rallying. And of course, there was a technical, the divergences and everything covered recently. But all right, so here's where I'm going. There's the trend line. There's where we're going. We're going to zigzag down. And so today we're up. We have one of the strongest days since last bear, what the media calls the last bear market, when COVID hit. If the Nasdaq's on track to do its best day since 2020, and I've said this many, many times, 5%, 6% up days like today only come in bear markets. You only get them in bear markets, either during on the downside or right after it's over. They don't come in a healthy, normal bull market. And just because it's bear markets, you have you're chock full of short interest. You have stock prices down. The vast majority of market participants being hedge fund managers, institutional investors, and the likes, as well as individual investors, the vast majority go long only. They only buy. They don't. There are hedge funds and there are flexible traders like myself that are just as comfortable shorting as buying, but we're the relatively small minority. All right, so there's always going to be, until you reach that point of capitulation, which we have not, that point of where most bulls just give up hope. There's always going to be those looking for a bottom, and that's what we try to identify and catch these little bottoms and trade the bear market rallies. And so, like I said earlier, today didn't change much. So let me just jump into where I'm going with this. All right, so we talked about interest rates. One of the reasons that I believe that that again, we're talking bigger picture here, because that's very important when and this whole video is going to be about that negative feedback loop that I'm talking about here. Is you have to formulate a longer term opinion. That's what I'm doing here, and it's not arguable that we were in a long-term bear market in interest rates, and you can use your own metrics, but I use the traditional ones, and as I covered in other videos, every metric tells me that bear market's over. We've taken out all the previous several major reaction highs, plus most importantly the primary downtrend line. And so therefore, let's just go under the assumption we are now in a new early part of a new bull market in rates. We're going to be looking at an inflationary rising rate environment. Okay, just going off that. Now here's where the whole feedback loop thing comes in, and this is why you're going to see these relief rallies, and some may only be last days, some may last weeks, some are going to last months, until the whole thing is over and the trend changes, the primary trend. And now what's going to happen is, equity bulls are giddy on the rally today, rightfully so, big rally, right? Now let's talk the thorn in the stock market side, which is inflation. And this is where Powell, unfortunately, and company just cannot win. We're coming off a multi-year bear market in commodities. You can see commodities. This is my go-to commodity ETF, DJP. It has a very well-balanced portfolio of various commodities in there. Metals and agricultural commodities and oil and all that good stuff. And we had a commodities bull market that ended in 2008, and we've been in just a smackdown vicious bear market all along until COVID hit. until all that excessive money and stimulus in the system finally triggered and let the cat out of the bag, and inflation started. It was a 78%, almost 80% drop there, bear market in commodities, and this ETF does a good job tracking. And then, like I've mentioned, by every metric that I use, especially previous highs being taken out, primary downtrend lines, positive divergence, everything, we are in an uptrend, a new bull market in commodities. And there's going to be abatements. Fed's going to be aggressive, rates are going to go up. You're going to have a combination of two things. Number one, profit taking from just bulls, commodity bulls that have been in these commodities, and nothing goes up forever. Remember, everything is an escalator, stair steps up. And you're going to get those corrections. And then you're going to have days like today where and maybe the market's even right in thinking at this moment, if you ask Powell what he's going to do based on that, but he doesn't know. Powell and the Fed, they'll make that decision at the next meeting. I've always said the Fed's reactive, not proactive, but they have time before they have to do anything, unless they wanted to do an emergency rate hike or cut between. But that's the odds of that are near zero right now. Unless there's some kind of shock to the financial system, which is still very much an omnipresent risk right now. All right, but back to this. So here we are. We're zigzagging up in commodities. So let me just cut to the chase here. Let's talk about today. DJP, the broad-based, we just want to say commodities as a whole are up 1.26%. Let me just rifle through a few of these and show you this is where the negative feedback is. So we had, a little abatement of inflation numbers, a little lower than expectation, but still very high, right? Here's platinum. I'm just going to go over these ETFs. I'm going to read it to you. 5.09%. At resistance given, I wouldn't be a buyer here. In fact, you'll get a pullback most likely. You can see it's at a pretty decent resistance level I had. But with that being said, it's also a very bullish chart. Here's a primary downtrend line. There was a divergent low, and this one's been shooting up. Platinum has a very much has an impact on inflationary forces. Platinum and palladium are two of the biggest components that are necessary in automobiles to reduce, in the emissions, and throughout other components, but that's their biggest uses in autos, and so therefore this is inflation. It had an impact on the automakers when we were running up here. It was really cutting into their profits. Platinum and palladium prices very high, and like everything, it's had an abatement, a correction, but it's moving back up, and it's moving up strong, and that's my point today. So while all eyes might be on the stock market, this whole thing, it's going to be a game of a back and forth seesaw, and so the market's going to rally on lowered inflation expectations, thinking, oh, the Fed's finally got it under control. One single report, and now look, palladium just hit big support right here. Here's another big one, and it's up 5.5% today. So you're up as much, pretty much, as these metals as the stock market. And across the board, we can go down. These are ETFs that hold timber and forestry companies, but cut up big, wood up, all up about what the stock market is. Coffee's rallying. I threw that one out as a trade idea the other day, up 3.6%. You can look at KC if you look at coffee futures, and more importantly, going up more. And so this is where you're going to have that negative feedback loop where market gets rally, the technicals are bullish, people start buying, and then all of a sudden, well, you don't have to wait for the next CPI report. It's going to be a while. You have to wait another month. But guess what? You're going to, if these charts play out, look at KC, coffee futures, breaking out of this bullish falling wedge. There it is. Big positive divergence. Nice resistance there. First target at 174, and if it pops that, it's likely to run and resume its bull market. Remember, bigger picture, coffee and all these other things, they're in corrections right now, and you can go back in time here. We'll do that. Here's a weekly chart. Joe, they changed this. It used to be the old Joe, and then that went to JOFF. The iShares or iPath revamped some of these, so you'd have to go back to the coffee futures chart to see the longer term trend, but I can tell you it was down, and then boom, bull market and a nice correction, and we'll probably get the next leg up soon. So you're starting to see that. Also a beautiful pullback to support. This was a level back here. I've had these charts, these lines on my chart for, I'll tell you right now, I created that line back on July 30th, 2021. It was resistance, and we pulled right back to it to the button. We took out this downtrend line right here. I might have mentioned it here. We broke out, and all we've done is back tested it for a few days, last 4 days or so, trading sessions. And so now this one's starting to take off. So that's it. We can go through them all. MOO is Ag Business ETF. So that has actual individual stocks, but that's also looking like it's ready to break out. Here's natural gas up at 2.19% today. Copper rallying 2-3%, at least the copper ETFs that hold the copper stocks at resistance, but rallying. Gold up strong, and gold, remember, has by all metrics that I have, is on a hard buy as well. That's where I've got a lot of trend money right now, trend positions in the safe former safe haven instruments, gold and treasury bonds and silver. And gold did just couldn't be looking any better after putting in that divergent low, false breakdown below that key 158 support, recovered it the other day. Successfully back tested, and still now we're well up above that level. And gold for right now, from where we're at this moment, would have to drop more than 3.25%, significantly more, to have this be a false breakout. So at this point in time, just like treasuries, I'm a buyer on any dips, any pullbacks, on gold or silver. And USO crude oil. Again, crude's rallying today. It did just break down this uptrend line right here. I tried to catch a bounce trade yesterday, and that didn't last long. Went right through the trend line, both on the futures and USO. But so you can see it, and now back testing. So I will say this, that there's an objective short because we broke down yesterday. Didn't bounce there, went right through it, but now we're back testing. But the takeaway again is crude is every commodity. I'm going over almost all the commodities on my watch list, and they're all rallying. And there's DJP that we already covered. There's cocoa. I threw this one out to you recently as a trade idea as well. CC, cocoa futures. I think I gave it to you on the 6-hour time frame right here. No, that's 3 hours. 6 months, 2 hour. Might have rolled contracts. I had a downtrend line, but either way, it was thrown out recently. NIB was the ETF, and look at this, ripping. And this is because you put in a divergent low, and I had mentioned this is one of the few that had really lagged behind a lot of the others. It's in a bull market, but it's had a heck of a run up, and again, up today. So that's the general takeaway, guys. GCC, another commodity ETF. Oil I already covered. UGA is gasoline, unleaded gasoline, up 1% today, and that's it. So now, as I started the video, remember, this is more macro stuff. Let me say that again. This is not micro and exact timing indicator or anything like that. To hone down, be more precise would be like, for example, treasury bonds I showed you today had rallied up into and overshot resistance and would probably have a reaction. I define a reaction as one of two things. When you're going up and you hit resistance, a reaction is either consolidation, which so far we had, or a pullback, or a combination of both. Sometimes you consolidate and then you pull back. And so you can see treasuries, since I fired that off this morning, have gone absolutely nowhere. They went up, they broke out the trend line, so longer term, that's a bullish event today. But it's, like I said, it's just like the stock market. There's been a lot of energy spent to get to where it is now. And the same thing with the stock market, with QQQ. There was the open today. There was that 1% plus pullback. We pushed back up and went no higher than not even a percent above the highs. And I think you'll see today is going to look like this. I'm pushing it hard. I think you're going to see a lot of institutions in trap longs take some profits. Again, today we're still above the recent lows. You can't chalk it up as anything but bullish, and we'll probably close green. I'll put good odds we're going to close green. I just think we're going to see some profit taken here before that. And then again, looping back to what the point of this video was, just keep an eye on that relationship. Again, it's that beautiful negative feedback loop that we're going to have, I think, going forward, and for now, certainly. And that is Every time there's a little abatement in interest rates, whether it's perceived or real, in other words, the Fed actually cutting rates or deciding at the next meeting to not hike and just sit tight, that would be an abatement. Well, that will most likely spur inflation again by the institutions and people like me that believe commodities are in a bull market. Well, any lower rates or even anything less than higher rates until inflation is contained. That's what I'm trying to say. The numbers today, we're still some of the highest numbers we've seen in decades and over 4 decades. It's not like they've got inflation back down to 2% where it was for the last 10 or 15 years. So that's the likely thing here. And again, it's not a day-to-day thing. You'll watch the overall trends. In other words, watch crude oil, watch natural gas, watch wheat, corn, soybeans, copper, gold, silver, and you'll get an ebb and flow where commodities are going. And as long as they're going up, and also rates, that's the other thing too. This little pullback in rates today, it's a big pullback, right? Here's TYX, 30-year bond. It's down 5%, right? The rates, the yield. So that's a big drop. What does that do? Well, it makes mortgages now cheaper, the cost of borrowing capital, which should give a little boost to the housing market, and that's been another bane of Powell, high housing prices and rents. And so again, it's a it's a negative feedback loop. If treasuries continue to fall and hit my target here, well, you're going to see a pickup back in home purchases and in new mortgages and things like that, and then that's going to be it's not going to help inflation get down to where it needs to go. So we'll have to, try to thread the needle here and know when to be long certain commodities, when to be short, how to, and same with interest rates, when to be long bonds and when to be out or short. And the same thing with equity markets. But I think, like I said, I think today everything I'm seeing, I want to believe there's some, the real money in the markets and institutions. And I'd like to think that there's some smart guys and gals on Wall Street and these pension funds and hedge funds that, despite the bullish technicals, because again, that's the one thing, pushing the shorts hard today, but I'll be lightening that position up once I get the fade, and then decide where to go from there. Because all said and done, I keep saying this over and over, until and unless they take out the lows. Like I always say, support is support until and unless broken. And as of now, we have not only massive bullish engulfing candlesticks at the lows, but we still have the positive divergences, and we're still above those lows. So we're kind of at the point where, like I said, we're also at some Fibonacci retracement levels on the markets. Oh, by the way, if you didn't catch it, I made an update on the last video. Let me show you that, and then I'll wrap this up. I made a correction. I had fib clusters. I was correct on the S&P 500 futures, ES being at the 50% Fibonacci retracement. But on NQ, I had a series of fib clusters on that chart, including one off the high, and I was referring that mid-August high. I was referring to that, although it was this fib I was looking at, and this is that's the mid-September high. That's a major reaction high as well. You can see, and that's the fib that we were at when I was saying we're at the 38.2 on NQ. So we are at the 50% fib on ES. Off the mid-August high right now. You can see it stopped at call today plus price resistance, hence a big part of wanting to be short into this big pop, into resistance, price, and fib. But then I just wanted to clarify for you that's the mid-September high where I took the other lines off because I had a bunch of fibs on that chart. Some were overlaying other ones. That's what are called fib clusters. You look at all the these reaction highs, and then you can put up fibs, and when you have certain fibs overlap others or in very close proximity, those are called Fibonacci clusters. So that's where we're at, and we'll continue to watch commodities, and it's a kind of a day-by-day thing. There's no way to know when the markets are going to kind of get that memo, but that's what I'm watching today. And it's been a pattern. I've pointed this out before. Every time there's been a rally in the market based on a perceived pivot or backing off by the Fed, where we've seen the stock market rally, we also saw commodities rally, if not that day, shortly thereafter. And then that's the I don't, there's no way out of it if until the charts and the technicals change, and I can start making a bearish case on commodities or a case that the bull run is over. But right now you can't. I just went over the charts and showed you a lot of these. Just put in divergent lows, things like coffee going up. Wheat's still looking good. It's a little below the trend line on the ETF, and told you I'd wrap up, but we still have the divergence there, positive divergence. And let me make sure this one, I don't think that's updated. Is it? Yeah, okay, it is. So it is down today, but you still have pretty strong divergence. And I'm giving this one a little bit of room. And the energy stocks too. For the reason I just showed you earlier, we had crude oil right here. Crude broke the shot down through the uptrend line yesterday. Hit this $85 support right there. It was good support. Bounced and now is back testing from below. So it's up today in line with this, softer than expected CPI number. And point is, I'd give it room on the shorts, ERY or XLE. Those still look good from a technical perspective. Here's XLE, the energy sector ETF. And I'm sorry for rambling on with this video. I just figured there'd probably be questions on this one since I just threw it out there yesterday. Nothing, and I mean nothing's changed technically. You've got the bearish PPO crossover here on the daily chart. Last time you had that, you can see down below, here's your PPO. Bearish crossover right there. It occurred with that trend line break. Bearish crossover here. Trend line break, sell signal, 1, 2, back test, and then rolled over. And we're up today, but not that much. We're only up, and I say only, about 1.2%. And yesterday and the day before in the other video that I threw out, I said if you want to really kind of hedge up and don't want to take a lot of risks now, one of my favorite trades is short energy, long tech. And that trade would be paying off in spades today because your gains in tech, XLK is up 6.2, and the other component of tech really is, or the other two are XLC and XLY. Why? Because Facebook or Meta, it's Meta now, and Google or Alphabet are an XLC, and that's up 4.87. And then XLY is really Amazon and Tesla. So those are really the big fangs, or what I call FAME plus T. You include Tesla now because it's so big and has a higher weighting, and that's up 6.39. So again, I think that's, and it's paying off today to be long the fangs in short energy. It's a hedge trade. But it's not a one-to-one hedge. I'm not a big fan of one-to-one hedges. That would be like if you're long the Qs and then you buy puts on your Qs. Well, it's washing out, and you're the only one making money on that trade is your broker, because you're paying for the options. So, or to be long long QQQ and then turn around and short it too. It makes no sense to either get out. So I hedge up, but I use indirect hedges. I'll use things that are somewhat correlated, or maybe have an inverse relationship, and so forth and so on. So anyway, I just wanted to reiterate, I remain bearish on the energy sector, and I'm just looking now for a near-term fade of this rally, and then I'll kind of get my bearings and see if I should position for a leg up to maybe hit those the bear market rally targets, which are a little higher, primary downtrend line on the S&P 500 and or the NASDAQ 100 and the 200 days. All right, but we're still at resistance right now. I'm going to wrap it up here. And this has been Randy Finney with Right Side of the Chart. Have a great day.